Listen, putting too much money in a single fund, that fear you have, it's real. Not just some vague worry, but a gut punch that can keep you up at night. Because when you pile too much into one place, you're basically handing over your future to a single shot, a single team, a single bet. And if it blows up, you're not just losing dollars, you're losing credibility, momentum, years of work, and maybe your edge as a limited partner. No one wants to admit it out loud, but every LP feels the pinch of overconcentration. Maybe it's because chasing the next big fund seems too good to pass up. Everyone talks about the star manager. They're unbeatable, they've got the track record. But here's the cold truth. Stars burn out. Markets change. Teams shift. That safe bet can become a trap. Don't pretend you're invincible, because nobody is. You know too well that putting all your eggs in one basket isn't diversification. It's gambling with your own career, and it's maddening. You're frustrated because the system almost forces you into buckets that look shiny but are filled with hidden landmines. You can't just spread your capital randomly, it has to count. So what the hell do you do? Keep throwing good money after bad, or dig your heels in and break the cycle? Step 1. Stop divorcing risk from your math. Yes, track records matter. But don't get dazzled by a single stable or a single fund's past performance. Look deeper. Are their investments spread across sectors, stages, geographies? Is the manager leaning too heavily on just one idea or one market trend? If yes, that's your danger sign. Double down on asking tough questions your peers are too polite to raise. Step 2. Build your own muscle to say no. You want to be the LP who can pass on a shiny fund because you have other, less obvious, but equally sharp opportunities waiting. Find those managers who aren't the usual suspects, those who aren't following the herd, but carving out a niche that actually matters. Stop competing for the same slice everyone's chasing. That's how overconcentration sneaks in. You chase the hot fund, you crowd in, then the whole crowd takes a hit when it falters. Step 3. Get creative with your portfolio construction. One fund might only need to be 15 to 20% of your total capital. Yes, even if they're the best. The rest? Layer in different vintages, strategies, and yes, even risk profiles. This isn't about playing it safe. It's about giving yourself the flexibility to breathe if one bet stumbles. And flexibility isn't weakness. It's the sharpest edge you have. Here's the brutal part. You can't expect anyone else to keep you balanced. If you depend on the market or the managers to warn you, you're already behind the 8 ball. Own your mix. Own it aggressively. That means spending the restless nights obsessing over your concentration, asking the hard what-ifs, and refusing to be blinded by shiny narratives or flashy pitches. And when you do this, you're not just avoiding disaster, you're building power. Power to make smarter plays, power to say no, power to stick with the winners who actually deliver when the noise dies down. Overconcentration fear. Use it. Let it fuel ruthlessness in your capital allocation, precision in your relationships, and clarity in your strategy. Don't settle for the easy, put more money here crowd. Be the LP who reads the room better than anyone else. Be the one who masters risk because they refuse to be a victim of their own choices. Overconcentration isn't just a risk. It's a symptom of the lazy LP who lets the hype call the shots. You want to win? Get obsessed with the numbers no one questions. Get uncomfortable with your comfort zones. Hunt opportunity in the spots others overlook. And whatever you do, don't ever get trapped in that single fund fantasy. Your freedom, your legacy, your future depends on not making that mistake. Make the hard calls now so you don't pay emotionally and financially later. Subscribe to our YouTube channel and visit the featured link to discover more.